Hey, left, right, out. What a rally we've had in the last couple days in the market. Unbelievable, rip-roaring one, I'd say. It's close to 1,500 points in the Dow. A couple of 100 days on the S&P 500. Of course, the day's not over as I'm making this. There's been some more information coming out about the Bank of England. In fact, the government itself has taken back or reneged on their tax cuts, which was one of the reasons why there was that was a catalyst for, no, I wouldn't say a reason, but that was a catalyst for some of the reaction in the market turmoil. Sorry if the phone's moving around. I'm just on the interstate, lonely drive, so it's moving around. But I just wanted to point out some of these. I've seen a number of articles saying, the rise in interest rates is causing this to happen, causing the market turmoil, causing stocks and stuff to fall. Which you could say to a certain degree that I would call that the pin. Let's get this correct. To me, that is the pin. But we don't look at but that's not the root cause. So when you want to look at the root cause, it's everything that's done before this. It's the low interest rates for a number of years, decades. It's the monetization of debt. It's the Marxist, non-market-based pricing of money, which is never the right price. So you get dislocations in the market, you get misallocations of capital. And then it tends to run amok and you get some weird reactions. Some of them are almost unpredictable at times, or almost, so they are. There's a lot of unpredictability about how these things react. So you see bubbles forming in other areas. Some of them hit bubbles, or some of them hit the pin. Some of them stay for a little bit longer. What was the other thing? Somebody else said something about rising rates is making people poorer. And I was thinking about that. I was like, no, if you're a saver, you're getting an actual return on your money, and or at the very least, you're losing less money. Because right now, I had one of my banks, the one that I have money in the market with, just popped their interest rate up to 2.75% on a savings account. It's like, well, that's not bad. It's still below in real terms, but it's at least positive. It's not zero. It's not 0.01, a hundredth of a percent, which is ridiculous. I mean, you're just losing money. You're pissing it away, sitting in an account. That's what incentivizes people into risk assets. 275, I'll set money there and hold on to cash or whatnot. That's fine. I mean, it feels better, a better sense thing. It doesn't make you poor. In fact, if there was a positive interest rate, that's how you develop wealth. That you don't have to go gamble in the stock market or something. You can actually, an average guy working an average job can set a little money aside and get a return on that. The people who do become poorer on that is people that are having to access the debt market. If you have to get loans, if you have to get a mortgage, if you have to get a credit card, or have to, I mean, if you do, yes, that's going to bite into your monthly cash flow. That is going to make you get that much poorer. But we should be talking in the realms of somebody that actually is trying to save, or somebody that has free cash flow at the end of the month. So this is having a positive interest rates. They're nominal, but at least there's something. Is actually a better thing than having 0% interest rates. In fact, in a real market, we have real money, interest rates are drivers of capital. If you have interest rates at the bank that are rising and incentivizes people to save, that savings builds up a pool of capital that can be lent out to credit-worthy businesses, startups, whatever the case may be, to get a return. I mean, this stuff actually makes sense when you're in a free market. You can logically go through it and understand how market forces react. It's hard to understand how market forces react when there is somebody with an infinite checkbook, somebody that has, a gun to other people's heads, in a sense. It's basically skewing the market. You're putting a finger on the scale, so you never really know. It's hard to logically think this. Let's look at the strong dollar deal. Strong dollar and yet there's still domestically there's a disconnect between a strong dollar in the world market and it is here, which you think in a real market, a strong dollar, of course, relative to different currencies, I understand that. But if you really had an actual strong dollar, if we wanted to use that as a adjective to what is actually going on, that should be putting a pressure on goods and services. That should put a downward pressure because you should denominate them with fewer dollars. It's makes sense. But there's this disconnect because of dollarization in other currencies as well. So, I mean, I don't want to get too deep in the weeds in that. We'll just leave it kind of there. Just some misconceptions of some things instead of we're looking at the first that node that's right in front of us again. That pin, instead of looking at the balloon and who is blowing the balloon up. Or we always use the heroin dealer analogy. There's a number of them. So I like to say that, stop blaming the pin and let's look at what created the bubble. So that'd be the low interest rates. Don't look at the high interest rates. The high interest rates are only a corrective mechanism to realign capital. And unfortunately, it's done like in a Marxist way by the central banks instead of them just allowing a free market. As soon as they allowed the free market to go in there, rational people, or some irrational, but most bond investors would be like, I'm not betting that I'm not going to take a whatever 2% yield for 10 or 30 years or whatever it is. It doesn't make any sense relative to the amount of liabilities this country has on its books. But that you will if the Fed's gonna push down those rates and increase bond prices, or you will take the other side of the trade and allow the Fed to backstop. It becomes very precarious. One good deed begets another, and therefore you end up squashing people out of the market. Not to mention, even with an infinite checkbook, when the government runs a huge deficit and they start sucking capital out of the market that would otherwise go into productive activities, or we'd hope, and low interest rate environments, sometimes productive activities, sometimes businesses that shouldn't exist. But the government itself sucks available capital out of the market when it runs these huge deficits like this. Just some things, little housekeeping items I've heard from guys like Glenn Beck talking about the interest rates are causing people to be poor. Well, only if you have to access to that market. If you're a saver and you've been doing that, you're actually getting some kind of return on your money now that sits in the account. You don't have to chase risk assets as much. That's the whole point. Granted, you're still under inflation right now, so it's not a positive rate. You're nominally positive, which is better than where we were before. But we just keep saying, keep an eye on what the Fed does in credit markets or consumer credit expansion, so you can understand whether you're actually gaining ground or you're still just treading water, or you're losing. The current's taking you further out to sea when it comes to this inflation stuff. Anyway, I'll leave it there, and I might talk a little bit more of that Russia thing, but I think I went into it a little bit, enough for you to look around and form your own opinion when it comes to the Nord Stream 2 sabotage deal. Anyway, talk to you later. Peace.